Hey guys, it's Team Real Estate Lifestyle. We are back with a new video. Today's video, we are going over what is a tax lien. We hope you guys enjoy. Let's get started.
What is a tax lien? A tax lien is a legal claim applied to a property when the owner fails to pay required taxes to the government. Tax liens total the amount of outstanding taxes, plus interest or additional fees accumulated by the property owner. They essentially serve as red flags, and properties with tax liens cannot be sold or refinanced until the outstanding taxes have been paid. Tax liens are relatively common across the United States. According to Investopedia, there was about $14 billion in unpaid property taxes in 2017. Tax lien certificates are issued by local governments and can ultimately be auctioned off to investors. By selling tax liens, the city can immediately earn back money lost in taxes. The widespread nature of tax liens has led to increased popularity among investors. What is tax lien investing? Tax lien investing is the act of buying the delinquent tax lien on a property and earning profits as the property owner pays interest on the certificate or from the liquidation of the collateral securing the loan. This gives you the right to take the property's deed if the owner does not pay off the entire delinquent tax amount, plus any fees within the redemption period, typically 120 days. In most cases, the owner has had months, if not years, to pay the taxes before the bidding process. An extra 120 days does not usually change anything. Are tax liens a good investment? Tax lien certificates can certainly be an excellent investment to add to your portfolio, as long as you know how to find tax delinquent properties. Like any other investment, the key is to know as much as you can about the property, the neighborhood, and the town in general. You never want to get stuck with a property that you don't see any upside in. How do tax liens affect mortgages? Tax liens do not necessarily affect mortgages, but they do impact homeowners and their credit. Property tax liens are treated as a separate debt alongside a homeowner's mortgage. When a property with a lien is sold, the lien remains associated with the property while the buyer applies for a unique mortgage loan. It is then the new buyer's responsibility to request to remove the lien with the county. Typically, after the sale of a tax lien, there is a period of time where the previous owner can pay the delinquent property taxes. The exact length of time varies depending on the state. Property tax liens remain on the previous owner's credit report even after the property has sold. This could affect their future ability to apply for and secure a new mortgage until the outstanding lien has been resolved. Tax lien investing pros and cons. There's no question investing in tax lien properties does contain some amount of uncertainty. But when compared to other forms of investing, it can actually have a much lower risk profile. Though this can depend widely on certain factors. Quite simply, the rules and guidelines regarding tax liens vary depending on what state a property is in. There can be some variance regarding the redemption period, return rates, and the bidding process itself. It's important to know the general rules before you make a bid in your state. To better prepare yourself, you must evaluate the pros and cons. Tax lien investing pros. Low capital requirement. Tax lien certificate investing offers a much lower capital requirement when compared to other forms of investing. It's possible to jump into this asset class for as little as a couple $100. Rate of return. The other big advantage investing in tax liens gives you is a fairly standard rate of return. Unlike flip investments, which can be volatile, with tax lien investing, you have a solid understanding of what your return will be, without having to second-guess the market. Lump sum payment. You are paid a fixed sum when the tax lien investment resolves, which means that it's easy to calculate exactly how much you'll be receiving and what your rate of return is. Also, because the payment is not in the form of an ongoing residual, you get all of your returns at once. Tax lien investing cons. Lack of recurring income. For some investors, the fixed payment aspect of buying tax liens can be viewed as a drawback. When receiving a fixed payment, it may not align with some investors' financial goals, especially if they are looking to create residual income avenues over time. Possibility of subsequent liens. Even though tax lien investment requires very little upfront capital, they can, on occasion, require more capital as the process moves forward. This is because, as the initial lien holder, you will be required to purchase any subsequent liens. New tax liens take precedence over old liens. Sad but true. Competition. The other slight disadvantage is the amount of competition you will likely face, usually from money managers and fellow investors, in your pursuit of tax liens to purchase. The best remedy for this is to know your geographic market well and target low-cost liens, in the $100-$200 range. The big money managers and investment firms are looking for a higher yield than these smaller investments can provide. Neglected properties. Be cautious of distressed properties or areas with environmental damage. Investors may not want to get involved in areas with chemicals or hazardous materials on the property. These could signal cases where the owner is simply unable to pay the outstanding taxes, and investors will not see any returns.
Thanks for watching, supporting, and showing us love. Don't forget to like, comment, and subscribe. Let's go, champs.